Good afternoon, everyone, and thank you all for joining us for the second module in the series, The Not-for-Profit Balance Sheet, with Professor David Gilchrist. We hope you enjoyed the first session about 4 weeks ago, and I'm pretty sure you will enjoy this session as well. David.
Thanks, Natalie, and thanks everyone for the opportunity to come back and talk a little bit more about balance sheets. It's amazing that we can spend so much time looking at these things, but of course the balance sheet is an incredibly important tool. So I hope to today talk a little bit more about the balance sheet in the context of working capital, profit and reserves as a continuation of our discussion. Before I do that, though, I'd like to acknowledge the First Nations people from New Zealand, and also in terms of the Whadjuk people of the Noongar Nation here in Perth from where I'm presenting, and to pay my respects to elders past, present and emerging. I'd also like to say thanks to Grow for the opportunity to present today, and always really happy to receive feedback or queries and comments. From the last session, we had a couple of queries come through, which hopefully I was able to answer satisfactorily. So my communication details are on the last slide in this presentation. So really happy to look at that and to discuss anything that you might have in relation to queries and so on. The other thing I'd say is that you might recall that this presentation series is built off the back of the Not-for-Profit Balance Sheet, which is a resource that we've developed with funding by Commbank, which we're really appreciative of. And I think it's free download from our website. It's well worth having a look at in the context of this discussion. So each of the 3 webinars refers to the tool in some way, shape or form, and certainly covers material that might be helpful to you and your boards and others that are making decisions about the financial well-being of your organisation. So moving into today's topic then, what I want to do is to speak to the issues of working capital, profit and reserves, and some of the issues around what the rationality of pursuing these elements is from the point of view of sustainability and good governance, but also perhaps to have some discussion around some of the communications and other threats that might be relevant to charities and not-for-profit organisations considering these areas, and that's particularly in relation to profit. In that regard, I want to make some key comments, I guess, particularly in relation to sustainability, because of course, working capital, profit and reserves are all relevant for the sustainability of an organisation in the short, medium and long term. And I want to, I guess, contextualise my comments in that regard first. Then I'll have a look at working capital, its purpose and governance. Look at profit, which of course is not a dirty word, and that's certainly something I spoke about last time. And if you've heard me speak before, I'm very, very keen for the sector to be picking up or replacing the word surplus with the word profit, and I've got some rationality for that. But also looking at reserves and what kinds of reserves you might have, but also more particularly how you might govern those reserves. Really happy to take questions as we go, but also Natalie will be looking at the chat feature and we'll be consolidating questions. And so my plan is to talk for about 35-40 minutes, and then to have plenty of time for Q&A, any discussion. Really happy to be told I'm wrong as well if that's something that you consider. And then we finish up within the hour, I hope. So hopefully it will only take an hour of your time. Let's get into it then. So in terms of key comments, I guess for me, sustainability is a really important consideration. And in not-for-profits and charities in New Zealand, Australia, around the world, of course, a lot of the governance framework or the board members are appointed as people who want to contribute, which is fantastic, and who are usually very, very committed and have great capacity in terms of their daily life and the work that they undertake. But often we don't think about sustainability in other than financial terms in the not-for-profit charitable sector. And I guess one of the things I'm really keen to contextualise my comments with is the idea that sustainability in this sector is actually broader and I think much more challenging to achieve than sustainability in the commercial sector. And that's based on 2 fundamental elements. The first element is that, of course, a charity or a not-for-profit corporation is not a raison d'etre in itself. In other words, a commercial corporation, of course, is something that is designed to make wealth for the shareholders, and there's no problem with that. It's absolutely how it should be. But a not-for-profit or charitable corporation is designed as a tool for the pursuit of the purpose. And therefore, the second comment I'd make about sustainability is that sustainability, in my mind, for not-for-profits and charities is calculated in the context of being able to continue to pursue the purpose rather than in the context of the continued survivability of the company, if you like. And I'll come back to that, but that might also be something people want to discuss, because it is a concept that is often foreign to volunteer directors that might come from the commercial world and have a very corporate-centric view rather than necessarily a purpose view. And that's not because they're bad people or they're the wrong people, but it's generally because we don't talk or commentate in this area around sustainability in that context. We tend to talk about purpose as one thing and sustainability as the other. And so I guess a central message I want to send here today is that, to my mind, sustainability is about being able to continue to pursue the purpose of the corporation, the charity or the not-for-profit. And to that extent, I think continuity and sustainability is around being able to continue to provide the right services in the right quantity, at the right quality, and at the right time. And this is a crucial element around judging sustainability and being able to make decisions about things like what the profit level should be or what reserves should be. And I think this is also really important because a lot of not-for-profits and charities really struggle with that idea of being able to identify targets for profitability or for reserves. And so I think this is a great context to try and put those targets in. Obviously, in order to remain sustainable in that definition, you really need to ensure that you have sufficient cash and an appropriate asset mix to make it happen. So I guess to be able to provide the right services, the right quantity, right quality, the right time, that sufficient cash and appropriate asset mix is absolutely critical. We're not going to talk about asset mix today. That's actually part of the presentation next week when we talk about replacement of assets and so on. What we're going to talk about today, I guess, specifically is this idea of sufficient cash to be able to support that ongoing sustainability. The other element of sustainability that I think is important, and we introduced in the last seminar, relates to sustainability over the short, medium, and longer terms. And there are different types of sustainability that are relevant in that timing segment. So as you can see here, we talk about solvency in the short term, being able to pay your bills as and when they fall due. In the medium term, we talk about sustainability, as you can see, in the context of my definition of sustainability, being able to continue to provide those services in the quantity, quality, and timing required in terms of the mission or the purpose of the organisation. And then, of course, sustainability in the longer term relates to issues around asset replacement, the asset mix, and so on, which, as I say, we'll talk about next time we catch up in a month. But what is relevant today then is, in terms of that solvency, is cash flow and working capital, which we'll talk about shortly. Of course, in that longer term, leave entitlements and depreciation estimates turn into cash issues as well. And I'll touch on those as we go through our discussion. And ultimately, asset replacement becomes really important when we consider how we move forward. I guess the most important thing to remember is that sustainability needs to be considered in the short, medium, and long term. It needs to be considered immediately, but a financial planning process needs to be put in place for the next 3 to 5 years as well for the organisation. And again, there might be some questions about that because we certainly had them following the last session that where I discussed that more fully. At the end of the day then, I guess the most important element is cash. And without cash, of course, an organisation can't survive. And I think this is critical. It impacts, or rather is impacted by profit. It's impacted by reserves, but it's also impacted by your financial planning and focus on things like philanthropy and also understanding what kinds of cash reserves you need in your organisation. To that extent, I think it's important to really appreciate what your target cash levels are. What is the working capital required in the organisation and how can you be more efficient? I'll touch on that shortly. And then those reserves, what kind of reserves do you need to build and what kinds of reserves are going to be necessary for the organisation, particularly in that mid to longer term view. The other thing that's important to remember in all of this is that perhaps some of you are already thinking, well, it's fine to talk about profit and it's fine to talk about cash reserves, but where do we get these cash reserves from? That's certainly a question that's really important. I guess my philosophy in this discussion is not so much to say, well, you just go out and make a profit or you just go out and make cash reserves. But as I discuss it a little bit more when we talk about profit in this session, I'm really concerned that organisations know what their needs are with regard to cash in the short, medium and long term, define sustainability that works for them in the context of purpose, and then understand what the gap is between what they're actually able to do or what their reserves are and where they would like to be. And I think this is a really important question or consideration, particularly for boards. It's understanding what that cash gap is in order to then be able to mitigate that cash gap. And without having that appreciation, it's very hard to develop the strategies that are necessary to make it work. So at the end of the day, the other element I think that's really important here is reporting of those outcomes and also those profitability issues, which I talked about before. Fundamentally, though, in terms of sustainability, of course, cash is king. Without cash, you're unable to survive in a market economy such as that's structured in New Zealand. Even though it's a mixed economy, you still need to be cash positive in order to be able to survive, as we all know. So what does working capital look like? Or what is working capital at the end of the day? Well, really, working capital is the amount of money that, if you're my age, you might define as being required to be in your check account. And I recognise that people don't have check accounts anymore, but at the end of the day, the check account or the operating account is that account where all of the wages and all of the electricity bills and all of those things come out of, and where generally income goes into. But in that check account or that operating account, we've got two major targets, I guess. The first major target is that we can keep sufficient cash in that account to be able to pay our bills and our staff when those payments become due. At the same time, the second question or the second target is not to hold too much cash in that account, such as we become very inefficient in terms of the use of our cash. That is, whether we invest that into assets or into other operations, or whether we invest that to be able to gain a further financial income stream for our organisation. And so we determine working capital to be, at the end of the day, that amount of cash that is required to keep the doors open and to keep the balance between the timing of payments and income, but at the same time to keep that as low as humanly possible. How do we represent that? Well, often we represent it in a diagram like this, where we provide a service, pay staff, pay creditors and invoices, and our debtors ultimately pay. Now, in some areas, this is much more positive area for organisations than in others, because governments might fund your operations up front or in advance, but increasingly governments are funding operations in arrears and based on invoices on what's actually been done, as opposed to what might be proposed to be done. And therefore, I think this working capital consideration becomes much more important for those charged with governance, to ensure that you have sufficient cash on hand to be able to do the things you need to do. Clearly, though, this is also a cyclical process. And so at the end of the day, the debtors pay, you provide service, and you go in this continuous loop where you're trying to work out how much cash you need and what that reserve of cash needs to be to make your directors and your executive and others feel comfortable the organisation can pay its bills as and when it's due. At the end of the day, the area between this red line and this blue line is the area where governance really needs to be undertaken, because we want this to be as small as possible, but of course we want it to be determined or balanced as possible, to make sure that the organisation is not going to have a cash problem at any point in the foreseeable future. The other thing I would say about working capital is that working capital relates to that short-term solvency issue that I talked about before. So in terms of those three periodic elements, working capital is in that first element, as I demonstrated in the previous slide. So how do we actually govern working capital? Well, there's a number of ways to do that. And in the last seminar, we talked about ratios and how important those were to those charged with governance, and also executives and others, to understand the financial performance of an organisation. And those ratios relate to the balance sheet as well, to the P&L and to other financial reports. In this case, we're looking at ratios that might be able to help those charged with governance to be able to understand the working governance working capital element rather, of their balance sheet, and to be able to help people plan for that, but to also make some decision points or lines in the sand in terms of where there needs to be changes made to ensure solvency of the organisation. The thing about ratios is there are multiple elements to those ratios, and so therefore a ratio can be a really handy indicator about how well the organisation's performing in relation to working capital, because it combines a number of elements on the balance sheet into one number. That one number makes it very useful, because it can not only tell us what's actually happening, but it can also give us a target or help us to obtain a target and to be able to compare that actual ratio outcome with the target to make sure we're confident in relation to our solvency. Clearly, in relation to working capital, that ratio needs to have a target that is set at a point where, as I said before, we don't have too much working capital and we're inefficient, but we don't have insufficient working capital situation where we can't pay our bills. The problem, though, with working capital ratios, as well as any other ratio, is, of course, it's very arbitrary. And so as situations change within an organisation, not only do you need to keep track of your working capital ratio, so what your actual performance is, but you need to continue to revisit that ratio target that you've identified to help you make decisions to make sure that that is a relevant target to your organisation. So at the end of the day, ratios are really important for that governance focus and also the forecasting focus, but importantly, help you to support that directional analysis of your balance sheet. So in other words, where should you focus your time and effort? In the case of working capital, then we have actually traditionally in accounting a working capital ratio, which is this particular formula, which is current assets over current liabilities, as you can see there. The kinds of things that we might see in current assets or consider in relation to this working capital ratio include debtor collection. How often do our debtors pay? How much of our debtors are actually paying? They're all considerations in the context of this working capital ratio. The debtors are those people that owe you money. We want to make sure that they're actually paying on time and as early as possible. That helps you then reduce your working capital requirements, because it is the debtors that you're actually funding in your working capital, if that makes sense. Of course, the cash balance is absolutely critical part of this as well. But the other critical part is any uninvoiced income. That is, any work that you've undertaken where you haven't yet invoiced the client or the government or whoever it happens to be, but which will impact your working capital and make sure that you've got sufficient funds. I guess one of the red flags here is to recognise that when we're analysing our working capital, we need to understand the timing of debtors collection, the timing of uninvoiced income, as well as what the quantum of those things are in the context of comparing them to current liabilities. Some organisations have stock, which they also need to consider that stock turnover. So how many sales might you have and how quickly might you turn that stock into cash? So I guess all of these elements also have the other similar attribute, and that is that they're all to be turned into cash at some point in time. From a working capital governance perspective, our concern is what the timing of that conversion is and how can we speed up that conversion, because we want to turn everything into cash as quickly as possible in order to be able to manage that working capital effectively. What about the liability side, the things that we have to pay? Well, of course, employee entitlements are an important element here. Unearned income is an important element. So we need to take into consideration in that cash balance that situation where government might pay us in advance, but where we've still got to complete the work. In other words, we might be paid in advance for services, but we still have to pay employees and incur other expenses in order to deliver those services. It's not free cash. We need to take that into consideration in calculating our working capital requirements. And of course, the obvious one is creditor payments. How quickly should we be paying our creditors? Are we paying them within the time frame that we're supposed to pay them? And if we aren't, how do we manage that to make sure that it's in line with our working capital requirements? So one other red flag there is that we might identify a working capital target for the organisation in the form of a ratio. And that ratio should be that current assets should be bigger or larger than current liabilities in order to be able to present that outcome.
I've got a quick question, David. Is working capital ratio the same as the current ratio?
It can be the same as the current ratio, but the current ratio can have non-cash items in it. So, for instance, on the positive side, in the asset side, you can have what's a good example? You can have some accounting estimates around income as a result of things like valuation increases in assets and so on. In the liabilities, you can have some liabilities that are related to non-cash items, such as income in advance, which I've already talked about, which is unearned income that you need to think about. But unearned income is already cash in the bank. And so, yes, the working capital ratio is often similar to the current ratio, but it relates only to those cash items and those items that are going to turn into cash in the very short term. So those things that are going to result in cash inflow or cash outflow.
Thank you.
My pleasure. So the other element, I guess, is profit. And profit is often seen as a dirty word in the not-for-profit and charitable sector. And indeed, my crusade has been very much around accepting the term profit and loss in this context rather than surplus and deficit for a number of reasons. But one of the things that I wanted to red flag here, as I suggested in my introductory remarks, is that we really, as a sector globally, need to start to talk about profit as a legitimate element in financial governance of a not-for-profit or charitable organisation. And the level of misunderstanding in commerce and in government policy areas, as well as in the sector, to be frank, around this issue is really concerning, because at the end of the day, in a market economy, as I said before, you cannot be financially sustainable unless you're making a profit as an organisation. There's some accounting issues around that as well. So, for instance, in relation to profit, surplus, the word that's often used in relation to charities and not-for-profit, really refers to held cash that's not required. What you're communicating to your stakeholders is, when you talk about a surplus, is that the money that has been generated is no longer required by the charity. It's money that could be arguably handed back to government, handed back to those other stakeholders, or handed on to another charity that might use that money more effectively than you do. Now, I know that's not the intent in not-for-profit and charitable reporting, but it is the effective outcome. Profit, on the other hand, so project element might be relevant to an example of a surplus where we've built the building, we don't need the money anymore, for instance. But in terms of profit, profit relates to financial gain. And I know that's a funny phrase to use in the not-for-profit and charitable sector, but it's important to remember that that financial gain goes into building the balance sheet and addressing the short, medium and longer term solvency and sustainability issues that I talked about before. So that financial gain is a really important element in the context of financial governance for any organisation, but it does articulate with the balance sheet as well for those reasons. It builds the balance sheet, builds the net wealth of the organisation, which subsequently then is applied to the mission. And I think this is a really important, communications strategy or a communications issue for those charged with governance, and perhaps also for executives to those charged with governance, that financial gain is important and it actually builds the capacity ongoing for the organisation. So profit is, of course, the income less expenditure. And I guess at the end of the day, as I've said, you must really be profitable in order for you to be sustainable going forward. The other thing about profitability, though, is that there are some key questions that I think are really important. The first important question is, of course, well, what should our profit be? And this is the age-old $64 million question for charities and not-for-profits. In industry, there are fairly strong norms about what the profit should be, say in the banking sector, in international trade and so on and so forth. It's fairly easy, to be frank, to understand what the parameters of your profit should be and what your profit target should be, whether you've performed well or not. It's gauged against your performance as compared to the industry. In the not-for-profit and charitable sector, this is really difficult because, number one, there isn't necessarily the data, comparability data, but secondly, charities and not-for-profits are almost always very different. Even those in the same industry have very, very different attributes and different focus points and so on that make it difficult to compare their financial returns to see whether or not you're falling within the normality area. But I guess the other thing that's really important in that regard is looking at profit, or determining what your profit target should be, really relates to what you need financially in the organisation and what that gap might be. So what do we do, or what do we ask in that regard? We certainly look at what our achieved profit has been. What does history tell us about that profit? And what value have we been building into the balance sheet on an annual basis as part of our operations? Of course, the next element should be, well, what should our targeted profit be? And I've got some comments on that, which I'll come back to. But of course, without a targeted profit, you can't determine your financial strategy, and you can't determine what that gap is that I talked about earlier in relation to supporting that strategy to help those charged with governance understand what the nature of the gap is and what the way forward might be. The other thing, though, that is really important is that it's all very well for me to say to you, well, profit is not a dirty word, but then does need to be a very strong communication process with your stakeholders in the context of profit and profitability, as there does need to be in relation to cash that you might hold as reserves in your organisation as well. So I think when you're talking about profit, you do need to think about how you're going to communicate your profit needs to your stakeholders, and also why profit is important to your organisation, what it means to your organisation in that short, medium and longer term sustainability perspective. So I guess the other element that is really important to think about too is the idea of profit from a consolidated perspective as opposed to a program or service level perspective. Now, I guess from an accountant's perspective, my philosophy is always that each program or service should be delivering a contribution, a profit to the organisation. And of course, the organisation needs to be profitable in a consolidated sense. The whole organisation needs to be profitable. I guess what I would say, though, is that we know that there are programs and services and parts of programs and services that often have to be funded by the organisation because there's simply not sufficient room within the funding arrangements from government or otherwise to be able to support those elements. And if we go back to that sustainability question, I said not only is it quantity and timing of services, but it's also quality of services. And your perceptions of quality might be different to those in the industry generally, or in terms of the government funders that might provide the resources. So in the context of profit here, I think there's probably two rules that are really important to my mind. The first rule is that when you are taking on the cost of service delivery that's over and above what's being paid for, the board and the executive of the organisation do that with intellectual understanding of what the financial cost is to the organisation. In other words, in my experience, a lot of not-for-profits and charities simply move forward paying for things, not really appreciating what the short, medium and long-term impact of that is. And then the second golden rule in that regard is, of course, at the end of the day, if you have a service or a program or part of a service or a program that you're prepared to pay for that's not paid for by outside support, then you also need to make sure that that's covered by the costs, rather by the profit that's generated out of other programs. In other words, that cross subsidy needs to be identified, but you need to be intellectually aware of that cross subsidy and what it means for your sustainability going forward. In other words, philosophically, there's no problem with having a program or service or part program or service not making a profit, but you need to be aware of what that actually means from a governance perspective. The other thing about profit is trying to determine the profit margin. I've already spoken about that, but at the end of the day, the margin is the actual margin, or the issue is for me, the actual margin achieved as compared to the target margin gives us what we call our target margin gap. And I think this is really important. As I said in my introductory remarks, a lot of not-for-profits and charities, a lot of people charged with governance in those organisations have a tendency not to think about targeting margin or a profit, but rather sort of accept that they can't do that, and therefore they don't actually develop a financial strategy around closing that gap, however that might be. And that might be by increasing income, of course, but it might also be by having advocacy increased in terms of increased funding from government and so on for particular services. How might you determine what your target margin should be? Well, there's a few different ways of doing that. The first way is in terms of an industry CPI. So many countries around the world develop things like health CPI, or a CPI is relevant to particular industries. In Australia, we have mining CPI and we have health CPI, amongst others. As an example, in 2020, health CPI in Australia ran at about 4.1%, while CPI itself ran at about 1.5%. So clearly, as much as a lot of indexation in government funding is associated with CPI proper, at the end of the day, health CPI might be more of an important target for you in relation to funding to ensure at least you're keeping pace with the increasing costs associated with the organisation's operations. Another example might be looking at for-profit comparators in some industries. So for instance, aged care, disability services in many countries are provided by not-for-profit organisations as well as for-profit organisations. And there can be some comparators there that might assist you in terms of determining what your profit margin should be, what your target should be. But probably the most important element is in relation to the financial plan needs and the cash requirements of your organisation. You'll recall last time I talked about financial planning as being a really important 3 to 5 year budgeting process rather than the typical annual budgeting process that we all undertake. That's not to say that annual budgeting process should be abandoned, but the 3 to 5 year financial plan process should illuminate the organisation in terms of cash needs, and you would take into consideration things like your asset replacement, change management investment where services change or government policy change, but also service redesign, that is re-engineering your organisation to be more efficient and more effective. Though both change management and service redesign are costly and require cash to be able to support that within your organisation to be effective. And of course, staff development is an absolutely critical element as well. What do we need to do in our workforce plan to be able to get our staff over the line in terms of what they need to be doing and how they need to be doing it? Are they appropriately experienced and appropriately qualified to do what we need them to do? So what about the gap? Well, that target margin gap, as I mentioned, is really important. Developing a strategy for closing the gap is very much the role of those charged with governance and the executives in an organisation. And of course, that can have a number of ramifications, as I said before, but fundamentally they drop into two buckets. The first bucket is, well, how do we increase income? It might be through philanthropy or expansions of services or mergers or other ways. The other bucket is in relation to advocacy, taking our data and our proof to government to try and get more money for a particular service or industry. Of course, the other element that is really important is that prioritisation of mission versus profit. And this is really difficult for people to balance. How much profit do you want to make? How commercial do you want to be as compared to those services or the extent to which you provide those services that are not funded, but that you know are absolutely important to the quality of the outcomes that are achieved by your organisation. That balance of prioritisation of mission versus profit is a fundamental issue for organisations, and each organisation needs to approach that differently and apply it differently in the context of their appetite, if you like, for commerciality versus these outcomes. As I said before, the demonstrability of that gap for advocacy purposes, I think, is absolutely important, as is that capacity to charge for your services and whether or not there's an opportunity there to be able to increase income through service delivery in different markets or in different ways. And I'm really happy to chat about that a bit more when we come to questions and answers as well. I guess the big thing here is to be aware of subsidising government procured service delivery. I think that's a big trap that not-for-profits and charities fall into, is essentially taking responsibility for government's priority allocation budgets, in their budgets, and leaving services underfunded, leaving it for not-for-profits and charities to resolve that outcome, if you like. Okay, so profit impact, just to recap on that particular section, results or should result in free cash flow, free cash that should be building the balance sheet. It also, though, results in appropriate pricing, and if not appropriate pricing, certainly it results in your understanding, better understanding, together with those charged in governance, of understanding what the pricing should be for you to be sustainable in the short, medium and longer term. I think it also helps with better budgeting for your organisation because you have greater appreciation, but importantly, as I mentioned before, it can result in that negative stakeholder consequence. And so the common strategy around this is absolutely critical to make sure that people understand what you're doing and why you're doing it. To that extent, that is also the key in cash reserves. Cash reserves are the third element that I wanted to speak to today, and I've just got a couple more minutes to talk to that. Capital reserves, or cash reserves rather, are part of your capital build as an organisation. And reserves are those elements that are set aside for a particular purpose or against a particular risk that your organisation might be facing. Capital build comes out of profit and or philanthropy or other capital provision that might be made. I guess charities and not-for-profits largely have been relying on government agencies, but also on lotteries systems in jurisdictions and philanthropists to be able to provide that capital build. It's typically very difficult for organisations to raise capital in other ways. However, I guess the key question then is, in relation to those capital reserves, how much is enough? And in order to understand how much is enough, you need to consider some of the risks and some of the financial sustainability issues of the organisation going forward. The first one relates to cash backing. So where you have longer term liabilities building in your balance sheet, and particularly things like employee entitlements, but also asset replacement liabilities and other liabilities building up, then you might consider cash backing those requirements to be able to ensure that you can pay them as and when they're due. This is often really attractive to employees, just for your information, because they're often concerned that organisations might be defunded in the not-for-profit charitable sector, and cash backing their entitlements gives them confidence that at least they're going to get their long service leave and annual leave or other leave entitlements paid out should the organisation be defunded. And I think that's a really important consideration as well. Of course, the financial plan requirements are an important consideration and should inform the cash requirements that you have in the short, medium and longer term, and be able to support that. The other thing to consider, though, relates to volunteer replacement and the opportunity or impact on your organisation and its business model where volunteers aren't able to be replaced because of demographic changes or because the organisation might be changing its business model or whatever that happens to be. And so one risk faced by some charities and not-for-profits is the risk where they have taken on a contract, been provided certain funds, but with the intention of using volunteers to provide part of that service to reduce costs. What happens if those volunteers aren't available? There's also reserves able to be built in relation to unearned income. And I think that's a really important element as well for the reasons I mentioned before. But if you don't have, if you have a situation where you have unearned income, there is going to be expense incurred by the organisation at some point in earning that income, and therefore it is completely legitimate to set aside that cash as a reserve against the time when you're actually going to provide the services. And then finally, I think it's important to consider those cash reserve requirements in the context of your infrastructure mix. So things like IT and so on are all increasingly important to the operations of charities and not-for-profit organisations. But as we all know, they cost a lot of money to be able to plan, to be able to implement and to be able to monitor over time. And so cash reserves might be built up to be able to of that infrastructure mix to ensure your sustainability going forward. The other element of cash reserves that I think is really important is the development of a cash reserves policy. And a cash reserves policy does three things in my mind. It articulates what the cash reserves are, why they're developed, which is an important issue I'll come back to in a second, but also how those cash reserves are governed. What are the decision points or criteria for spending that cash, and how do those charged with governance have confidence that the cash reserves are going to be retained, but the organisation is not just building cash reserves without the intention of using that cash or applying it in some way at some point in the future. So what are the attributes of a sound cash reserves policy? Well, the first attribute is that I think it's really valuable for it to be a public document. And that's important for stakeholders and members of organisations, not only to give them an understanding of what the governance is around those reserves, but as part of that communications process I talked about before, where if you've got too much money, it can be difficult for philanthropists and others to consider applications for funding because they feel that you've got enough cash. And so having a public document that articulates that cash reserve policy is part of the due diligence that those organisations might undertake, and part of the explainer as to why you're putting that cash away. You're not just hoarding it and looking for other sorts of cash to be able to do what you need to do. The other thing that a cash reserve policy does is ensure that the cash is used in a way that's consistent with its intended purpose. That is, those charged with governance can feel confident that the cash is only used for its purpose in accumulation. And that might be in relation to a new policy or framework or program, or it might be just in relation to cash backing employee entitlements before, as I mentioned before. The other element that's really important is in terms of that cash reserve policy is those trigger points. And trigger points relating to when the money's actually spent and how it might be spent and how it might be reported back to the board is a really important aspect that needs to be articulated in that policy. The access arrangements are part of that as well. And remembering, as with all policies, any cash reserve policy needs to be reviewed on an iterative basis to make sure it remains relevant and useful to the organisation. And particularly if it's a public policy, a document that's used to support your communication strategy, then you need to make sure that you're on the money in terms of it being manageable and that you're walking the talk, if you like, at the end of the day. So cash reserves, I think a really important element is that communication policy, as I mentioned before, that capacity to be able to tell funders and others why you've got that cash in the bank and why it's important to your organisation and why they should continue to provide cash, notwithstanding you do have those reserves set aside. So the key issue is that communication. The rationale, the purpose, the timing, the target, and the governance arrangements are all critical parts of that communication to give people confidence that you're actually using that cash and accumulating the reserves for valuable purposes aligned with the mission of the organisation. At the end of the day then, just coming back to the final sort of tie-up, if you like, in relation to the last seminar and this one, as we mentioned, the short, medium and longer term sustainability of an organisation is often inherently connected to the balance sheet. And when we think about the balance sheet, we think about the annual documents that we develop, which are the annual operating budget, the cash flow budget, and the capital budget, as you can see in that first column. They then articulate and inform the ongoing development of things like the asset reinvestment plan, as you can see there, and move on to that financial plan that I've been talking about. At the end of the day, from a cash perspective, we're really interested in this annual cash flow budget as part of that governance arrangement. So has the cash come in that we've thought it should come in? Has it come in the right timing? And have we managed our working capital to be as efficient as we can be? And also those employee entitlements in the longer term are absolutely critical elements. Managing those employee entitlements to make sure we're paying them out is critical, because at the end of the day, we're going to pay more the longer those employee entitlements stand out, because of course wages go up and we pay our employee entitlements based on those wages. Other things like loan capital repayments, estimates and others have to be incorporated there as well. Okay, I've very quickly gone through all of that material. I've spoken for 45 minutes, so I lied. I said I'd speak for 40 minutes, but hopefully we've got some questions and comments and we can finalise on those.
Thank you, David. Yes, we do have a question here from Fiona. She asks, can you talk about recognizing surpluses generated from unspent grants versus true profit?
Well, I guess in an accounting sense, you can't really recognise a profit from an unspent grant in the sense of, no, I'll back. What I would say, first of all, is when we're talking about an unspent grant, there are two elements to that. One is that we simply haven't spent the grant because we're yet to do the work, or we're yet to purchase the equipment or whatever it is the grant's been provided for. In other words, it's an unearned grant. We're yet to do the thing that we've been given the grant for. An unspent grant means that we've actually achieved the outcome, whatever it is, and we have some money left over from that grant. In the case of the latter, and of course, depending on the contract that you have in relation to the grantor and what they want, you would recognise that as profit. That would be income, because that income has been generated as a result of your operations and is genuine income that you're able to keep.
Great, thank you for answering that. Right. I'm pretty sure that that answers Fiona's question. Don't have any other questions at the moment in the chat, but perhaps they're still coming in.
And like I said, I'm really happy to get questions after the session as well, if that's easier, or more organisationally specific issues. Sometimes it's hard to talk about your organisation in a public environment, of course. So I'm really happy to talk more confidentially as well, if that helps anyone.
Yes, Fiona does have another comment. She says, yes, thank you for answering the question. It's just a bit of a trap to make sure it's treated properly if you need to return it or carry it over.
That's it. And I guess the third element too is, from a governance perspective, reconciling your initial ask and what you were provided against what it costs, to make sure that you're confident that you've implemented the project appropriately as well. Because it's a bit like IKEA furniture. You build the cupboard and you get to the end and there's a couple of screws left over. The cupboard's still working and it's all doing the right thing, but in the back of your mind, you're wondering if it's going to fall over or not.
Where do we put those screws?
Exactly. So having a bit of money left over obviously is fantastic, and if you can put that on the balance sheet as income, that's wonderful as well. But of course, you've got to make sure you understand why you've ended up with that discrepancy, if you like.
Yes. Often we find ourselves giving extra funding, but it's too late to spend it.
Yes. Yeah.
I guess that's always a balancing act for many non-for-profits.
Absolutely.
Funding, yes.
Yeah.
Yeah, as David mentioned, he's happy to take questions afterwards. So
absolutely.
if you want to email those to me, then you're also more than welcome to email them to me, and I can forward them to David.
Yep.
Don't think we've got any other questions. Erica does say it's really valuable and helpful. Thank you.
Oh, good. I'm pleased. And I'm really happy to get feedback on what might be more useful or valuable. So, delighted that this is useful, but there might be other things that you prefer to know as well. Don't hesitate. I'd be always looking for ideas about what can be useful to the sector.
Great. Well, I think we're going to conclude today's session then. David, thank you again for sharing your knowledge and your experience with us and being open to answering questions. Thanks everyone for joining us this afternoon, and we will do module number 3 in 4 weeks' time, but as I did with this time, I will send you the reminder beforehand. And as mentioned before we started, you will receive the slides and the link for the recording, most likely tomorrow morning, because it takes a bit of time for everything to be processed by the computers, but it will be coming. So thanks again, everyone, for joining us.
Thank you.
And we'll see you next time.
Take care.
Thank you.